Welcome back to this very special edition of Young Turks. We come to you from India Internet Day in Gurgaon. The theme of the conference this year is emerging from the froth. Now, while there's been criticism of startups of having over-leveraged themselves, there's also been a criticism of venture capital that seems to have hyper-funded startups leading to this froth in the first place. We caught up with investors here at the conference to find out what they thought of 2015 and what they think of 2016 going forward. Has funding slowed down or are things on track? Dave, thank you very much for joining us. I'm going to begin by asking you, you raised a $135 million fund in August last year. Where do things stand with the fund? What was the mandate for the fund largely, and how much of that have you seen deployed over the last 8 odd months?
Yeah, the firm Lightspeed India Partners raised a fund last year, 135, you're right. We've been investing in India as Lightspeed for the last 8 years, so since 2008 onwards, and we've been investing exclusively in technology companies. So with this new pool of capital we raised, we're doing exactly the same thing, technology companies that are seed, Series A and Series B in lots of different sectors. So in retail, which is e-commerce, in on-demand services, in digital services like entertainment and media, in verticalized consumer services like financial lending or education or health. And then we're also looking at B2B marketplaces and B2B software. In terms of investing, we've invested in the last 12 months. We've been deploying for the last 12 months in areas like on-demand services. For example, invested in a shuttle, which was a Series B we did earlier this year. This is an on-demand bus transportation company. We've invested in Fresh Menu in Bangalore, which is an on-demand food delivery company and food company. They have a brand of their own that's doing very well. It's the largest such food brand in India online.
Since you're talking about online demand services, what do you make of what's gone down in the hyperlocal space over the last year?
When we're looking at all these models in India, hyperlocal or food or local services or grocery or whatever, you have to think about the model. There are some models that have very thin margins. We think delivery is potentially one of those. Over time, I think the margins will emerge, but food has really good margins. The average restaurant has 60 to 75% margins, which delivery companies tend not to have. So it's a question about model. There's no question around demand.
There's been so much writing around the funding winter that seems to be upon us. As someone who is deeply immersed, how are you reading things? How are you seeing things?
We had a down cycle starting in 2000, which impacted India as well, which had a very nascent internet market at that time. We had a down cycle in 2008, and we are having a down cycle in 2016. There are, as an investor, as long-term institutional investors in the market, we don't time the market. We don't sort of say this is the only time to invest at the top of the market or at the bottom of the market. We just consistently keep investing in great companies and great entrepreneurs. And what we've seen over the last 20 years of investing is it doesn't matter when a company gets started. You can get big companies built no matter when they start. So that's just a precursor to saying that we haven't slowed down our investing pace. We did 7-8 deals in the last year, which is actually a little bit faster than we normally do. And we're going to do so many more this year as well. You said that you were interested in education, in healthcare, in commerce of different sorts, whether it was B2B or B2C. But out of these, what is the sector that you think 2016 will see come out on top? Forward-looking wise, there are two sectors we like. One is verticalized consumer services. So this is financial services. Within that specifically, consumer lending and SME lending. Okay. There's a $200 billion credit cap for SMEs in India, right? That's a big market to go after.
Let's talk about your latest venture, Indifi and not Indifi, just to let everyone know. So, how do you categorize this? Is this a fintech company? Is this a data analytics company? Is it a lending platform? Or is it a mix of everything? Help us understand the model.
Yeah, I just wrote a post saying, is this a bird? Is this a plane? And I think that's the reality of fintech today. It's very hard to disambiguate that term, so we don't call ourselves fintech. What we essentially do is to enable credit for small businesses, largely in segments which are underserved today. And we do that by partnering with large aggregators who can bring both the origination as well as the data tools to us to be able to draw scorecards and get our lenders comfortable in lending to those segments.
So is fintech the new food tech of 2016?
Yeah, I think that has two dimensions, right? One of scale, and in a market like ours, IFC has called out a market gap of $380 billion, right? So I think from a scale standpoint, certainly it seems like the opportunity is there. From a profitability standpoint, lending businesses have to make money on every transaction from day one. And so that's the ethos we have adopted. Now, do we land up being food tech, fintech, or no tech but a good business? We'll see.
Given the current scenario and given the industry sentiment, how are you positioning Indifi?
So, I think there is always capital available for good businesses. Last quarter's venture capital data came out, and the industry has invested $300 million plus in early stage businesses alone. I'm not talking about the billion-dollar fundraisers. So I think the market is still vibrant. Capital is available out there. We have to prove out our own thesis, right? So today we've got over a dozen partners, these aggregators, who act as the demand funnel for us and give us data, right? We've got 3 large NBFC lenders who are operating on our platform. We've done over 500 loans in the short span of last 6 months. So now all those are things that give us confidence that we are, barking down the right tree, and hence investors will see that story when they need to see it.
Oftentimes we see that there are good businesses that don't get VC attention or don't get VC money. So would they be turning to you, or would Indifi back ventures that usually VCs avoid? Yeah,
I think we, the VC backed ventures have a very different DNA and risk profile to them than businesses that are looking for debt capital, right? So our typical client could be a travel agency which has been running for 5 years but is constrained for working capital. It's a totally non-VC backable business, but needs working capital to grow their business. We have Kirana stores, grocery stores. And this is not food tech. This is the individual grocery store who we would lend to. He doesn't know what VC means. VC doesn't know what they mean. So in some sense, we are in a different space altogether from the high risk, high reward binary kind of ventures that VCs back because they have equity upside on that. Our lenders don't have an upside on the loan. At best, they're going to get paid 14% and done with it. And hence, they would back low risk businesses, but businesses that nevertheless will grow with availability of appropriate working capital.
Would you call your venture sector agnostic, or e-commerce is where all your attention is going to be? Because somewhere you did mention that eventually you will look at other sectors. So what would those sectors be, and what is the plan for the upcoming year?
Sure. So even today we are live in 6 different sectors. E-commerce is just one of those, contributes to only 20% of our business. We started out financing travel agencies, again through partnerships with Travel Boutique, and then off late we have added Via to that, which are ticketing consolidators for travel agencies, right? So again, they play the role of an aggregator in that business, but we are able to provision working capital for travel agencies. We are currently doing financing for hotels for minor renovations. We are doing grocery stores through the point of sale cash register. We are doing cab drivers through our partnership with Ola Cabs. We are doing manufacturing businesses for their raw material purchase. So we are already live in 6 segments, and we are exploring more segments. So by all means, we look at our business, which is extremely segment specific, because the risk and the product depend on which segment you're in, but it is not confined to e-commerce.
I'm going to begin by asking you, Rahul, venture debt, why? And you started this off sometime last year,
yes,
which was a crazy year for startups in India.
Yes.
What got you going?
Sure. So, okay. So yes, you're right. We started venture debt. We started a fund about a year and a half ago. Happy to say that as of October, we've been in business. We've invested in 7 or 8 companies in the last 6 months. In a lot of ways, venture debt is a natural evolution of the venture capital ecosystem. If you look in the US and in Europe, as venture capital reached a certain stage of maturity, founders and businesses needed alternative sources of financing beyond equity. And similarly in India, venture capital has been around 10, 12 years. We started to see patterns where companies were looking for additional capital, funding receivables, funding working capital, making small acquisitions, and none of that was easily available from banks or NBFCs. So that's really the opportunity that we saw. Over a longer term, venture debt is about 20% of the venture capital market. And so I think we're just getting started in India. Hopefully over the next 10 years, this will be a very large industry.
All right. You've closed, as per reports, the first 200 crores of the fund. You were looking to close up to 500 crores. Take us through plans on that. Are they on track?
Absolutely. So, unlike a lot of other domestic fundraising, we've actually chosen to focus on institutions, which take a lot longer to make up their mind, but once they do commit, they commit large pools of capital. I'm happy to say that, today we have some of the leading insurance companies in our fund, Life in general. We have a bank as an investor in our fund. We have several large leading family offices and endowments. This has never been done before. Most domestic funds have typically been HNI funded. So at this point, we have roughly 12-13 investors in the fund. We have much more than 200 crores now committed to the fund. We're confident that at the end of this calendar year, we should be at 500 crores. That in effect gives us the capacity to do about 1,000 crores of lending in this fund.
Do you think that we are at a stage where we are actually emerging out of the craziness of 2015, or do you think that some part of 2016 will continue to be as ruthless?
So, I've been investing since 2005, so I've seen at least 3 cycles like this. I think the challenge with India is that it is very spiky, and either things are great or they are not good at all. I think what's different this time is that from a supply of capital perspective, many of the top funds actually are sitting on large pools of capital. That capital has to be put to good use. So while there is a dampener on Series B and Series C rounds, there's a fair amount of activity at Seed and Series A. So I would say that if you're a young entrepreneur or if you're an entrepreneur who's looking to get started, 2016 is a good year because there is capital available. That money has to be put to good use. It's the ones who are looking at the growth rounds and the later stage rounds that are going to be challenged at least for another 6 to 9 months.
With that, it's a wrap on this very special edition of Young Turks from India Internet Day. Tell us what you thought of the program. Write to us on Facebook or on Twitter. You can also email us at youngturks@network18online.com. Till next week, goodbye, and thank you very much for watching.